$310 million. That is not a rounding error. That is not a misplaced decimal point on a junior accountant's spreadsheet. That is the monetary value of imaginary lattes, phantom macchiatos, and ghost coffees that Luckin Coffee claimed it sold to the Chinese public. It was a financial hallucination so potent, so intoxicating, that it briefly convinced the smartest guys in the room that a company burning cash faster than a furnace could somehow be more valuable than the gold standard of caffeine itself. But before the tears, before the lawsuits, before the humiliating delisting that wiped out $11 billion of wealth in a blink, there was the party. Oh, and what a party it was. You have to understand the seduction. The year is 2019 and Wall Street is desperate. They are starving for the next big growth story, drooling over the idea of the chaotic, booming Chinese middle class. Enter Luckin Coffee. They didn't just walk onto the stage. They kicked the door down with a narrative so perfect, it felt like it was engineered in a laboratory to bypass the skepticism centers of the investor brain. They called themselves the Starbucks of China. That's it. That was the pitch. It was simple, it was sexy, and it was a lie wrapped in a tech buzzword. This wasn't a coffee chain. It was a rocket ship disguised as a barista. It took Starbucks 20 years to build a dominance in China. Luckin. They wanted to do it in 20 minutes. Founded in late 2017, they went public on the NASDAQ in May 2019. 18 months. Think about the absurdity of that timeline. You have t-shirts in your closet older than this multi-billion-dollar corporation. But you didn't care about the timeline, and you looked at the charts, up and to the right. The graphs were beautiful, geometric works of art, showing store counts exploding from a handful to thousands in the blink of an eye. The logic was intoxicatingly simple. China loves coffee. Starbucks is expensive and slow. Luckin is cheap and fast. Therefore, Luckin wins. It was a blitzkrieg of caffeine. Investors looked at the massive losses, hundreds of millions of dollars set on fire to subsidize free drinks, and they didn't see a disaster. They saw customer acquisition costs. They saw the next Amazon. They saw a tech company that just happened to sell brown water. And when greed grabs the steering wheel, due diligence gets locked in the trunk. The alarming thing wasn't that Luckin was lying. It's that nobody wanted to check if they were telling the truth because the lie was making everyone too much money. If part 1 was the seduction, part 2 is the bender. This is the part of the night where you stop counting drinks and start believing you can dance. Luckin Coffee didn't just expand, they metastasized. They engaged in what can only be described as blitzkrieg caffeination. In the history of retail, nobody has ever tried to open stores with the reckless, terrifying speed of Luckin. They were opening a new location every few hours. Think about that. In the time it takes you to watch a movie, Luckin had signed a lease, installed a machine, and started losing money in a brand new neighborhood. By the end of 2019, they had over 4,500 stores, surpassing Starbucks in China in sheer numbers. But these weren't stores in the way you think of them. They weren't the cozy, jazz-playing leather chair sanctuaries that Starbucks built to sell you a $5 experience. No, Luckin locations were often little more than glorified janitor closets in office lobbies. Pickup kitchens with 0 seats, barely enough room for a barista to turn around without scalding themselves. They were caffeine-dispensing terminals. But the market didn't care about ambiance. The market cared about the map turning blue, the color of the Luckin logo. They were painting the country blue, one money-losing kiosk at a time. And how did they get people to drink this stuff? Did they hire Italian roast masters? Did they source the finest beans from the mountains of Colombia? Please. They used the oldest, crudest, most effective drug-dealing tactic in the book. The first hit is free, and the second hit is 90% off, and the third hit is buy one, get two later. They were practically paying people to drink the coffee. Coupons fell from the sky like rain. You could get a latte for the price of a bottle of water. They created a subsidized addiction, training millions of consumers to believe that a premium coffee beverage should cost less than a bus ticket. This is where the economics get hilarious. It was the classic Silicon Valley delusion applied to a cup of joe. We lose money on every single cup we sell, but don't worry, we'll make it up in volume. It is a logic that works if you are selling software code that costs nothing to replicate. It does not work when you are selling physical beans, milk, and paper cups. Every time a customer walked away with a Luckin coffee, the company was essentially taping a dollar bill to the cup and handing it over. It was a bonfire of venture capital cash, a charity for the caffeine dependent disguised as a high-growth business strategy. But you, the investor, you loved it. You saw the user numbers exploding. You saw the app downloads soaring. You didn't ask if these were loyal customers. You just saw a monthly active users and swooned. You didn't realize that these people weren't loyal to the brand. They were loyal to the subsidy. The moment the coupons stopped, the customers would vanish like smoke. But in the middle of the blitz, nobody stops to check the gas tank. You just keep your foot on the accelerator, watching the speedometer climb, ignoring the fact that the engine is on fire, and you are driving straight off a cliff. You know the old saying, if it looks like a duck and quacks like a duck, it's probably a duck. Well, Luckin Coffee looked like a coffee shop. It smelled like a coffee shop, and it sold coffee like a coffee shop. But if you asked the executives or the breathless analysts on CNBC, they would look you dead in the eye and tell you, no, you idiot, this is a technology company. This was the masterstroke. This was the tech disguise. Because let's be honest, nobody pays 30 times earnings for a company that sells hot bean water. But a tech platform? A data-driven lifestyle ecosystem? Now that gets a valuation multiplier that makes your nose bleed. Luckin's innovation was forcing you to use their app. You literally could not buy a cup of coffee with cash. You couldn't even walk up to the counter and order like a human being. You had to download the app, give them your data, and order through the digital interface. They claimed this was revolutionary new retail. They told investors that by trapping customers in the app, they were harvesting an ocean of behavioral data that would allow them to predict your caffeine cravings before you even had them. They sold the idea that their algorithms could optimize supply chains and delivery routes with the precision of a NASA launch. It was a brilliant sleight of hand. They took a low-margin, operationally heavy brick-and-mortar business and sprinkled Silicon Valley fairy dust all over it. They convinced the market that they weren't limited by the physics of roasting beans. They were scaling like software. But here is the cold, hard truth that got buried under all those buzzwords. An app does not make the coffee taste better. An algorithm does not make the milk cheaper. And no amount of big data can change the fact that if you are selling a product for less than it costs to make, you're not a tech disruptor. You're just a philanthropist with a broken calculator. But for a brief, shining moment, the disguise worked. The market saw a tech unicorn. They didn't notice it was just a donkey with a traffic cone glued to its forehead. While the suits in New York were high-fiving over the stock price, and the analysts were busy copy-pasting buy ratings into their reports, a shadow army was mobilizing on the streets of China. You see, in the financial jungle, there are predators who don't hunt for growth. They hunt for the lie. Enter the short sellers, specifically Muddy Waters Research, the grim reapers of fraudulent Chinese stocks. But they didn't act alone. They received an anonymous report, a dossier that looked less like financial analysis and more like a CIA field ops file. This wasn't some guy in a basement with a Bloomberg terminal. This was Operation Watchman. The scope of this espionage operation is genuinely terrifying. It was industrial-scale surveillance weaponized for profit. The people behind this report hired over 1,000 part-time agents and 90 full-time staff. Imagine that. An actual battalion of spies deployed across nearly 1,000 Luckin Coffee locations. Their mission? Sit there. Watch. Record. They didn't trust the spreadsheets. They trusted their eyes. They turned the boring act of sitting in a coffee shop into a tactical operation. They recorded, and I am not making this up, 11,260 hours of video footage. That is more runtime than the entire history of the Marvel Cinematic Universe, played back to back, 5 times over. They sat there with smartphones and hidden cameras, filming the counter from open to close. They captured every single customer, every single delivery driver, every single paper bag that left the store. It was the most boring, tedious, and brilliant stakeout in corporate history. While Luckin's executives were popping champagne and toasting to their exponential growth, these invisible eyes were counting. 1 cup, 2 cups, 3 cups. And here is the kicker. They didn't just count the cups. They cross-referenced the video evidence with the store receipts. It was forensic accounting with a sniper rifle. They realized that the busy stores on the investor slides were actually ghost towns in reality. They watched stores for hours where the only thing moving was the dust, while the company's internal data claimed orders were flying out the door like it was Black Friday. It was a clash of 2 realities. The digital fantasy Luckin was selling to Wall Street, and the physical reality of empty lobbies and bored baristas playing on their phones. The trap was set. The video files were uploaded, the math was done, and the weapon was loaded. You might think accounting fraud is complicated, a dark art involving offshore shell companies and complex derivatives that only a PhD can decipher. But Luckin, they didn't just cook the books, they deep-fried them in the most hilariously lazy way possible. The genius of the Muddy Waters report, the receipt of lies, was that it exposed a fraud so simple a high schooler could have caught it if they had bothered to look. The spies didn't just film the stores, they collected thousands of customer receipts. And when they lined those receipts up, they found a gap. A massive, glaring, impossible gap. Here is the trick. Luckin was playing hopscotch with their order numbers. In a normal business, order numbers go sequentially. 1001, 1002, 1003. Luckin decided that was too slow, so they started skipping numbers. Order 1001 would be followed by 1005, then 1012. They were literally skipping ticket numbers to make the daily volume look artificially high. It's like ripping pages out of a notebook and telling your teacher you wrote a longer essay. They inflated the number of orders by over 69% in the fourth quarter of 2019 alone. They were ghostwriting millions of customers into existence. But inflating the volume wasn't enough. They had to fix the price. Remember those coupons? The ones where they were practically giving the coffee away? Well, you can't report 0 revenue to Wall Street and expect a standing ovation. So, they lied about how much people were paying. They claimed the net selling price per item was rising, that customers were happily paying closer to full price. The receipts told a different story. The spies found that Luckin was inflating the price per cup by nearly 13%. They were telling investors, look, our customers love us so much, they are weaning themselves off the discounts. In reality, the customers were still addicted to the cheap stuff, and Luckin was just filling the gap with imaginary cash. And just to add a cherry on top of this sundae of deceit, they inflated the items per order. They claimed that when people bought coffee, they weren't just buying a lonely cup of joe. They were buying snacks, mugs, juices, a whole basket of goodies. The data showed otherwise. Most people just grabbed their cheap caffeine and ran. Luckin was essentially telling the world that every customer was a hungry, thirsty, merchandise-loving spender, when in reality, they were just bargain hunters. By the time you added up the fake orders, the fake prices, and the fake basket sizes, you didn't have a company anymore. You had a spreadsheet full of fairy tales. They created a mathematical impossibility where the revenue line on the graph detached from reality and floated away into the stratosphere, untethered by the gravity of actual cash. When the Muddy Waters report hit the internet on January 31st, 2020, it should have been the end. It was 89 pages of cold, hard evidence. It was a forensic autopsy of a living company. In a sane world, the stock would have gone to zero that afternoon. The police would have kicked down the doors, and the executives would have been fleeing to a country with no extradition treaty. But we do not live in a sane world. We live on Wall Street. And Luckin Coffee's response to being caught red-handed was a masterclass in gaslighting that would make a sociopath blush. They didn't flinch. They didn't apologize. They didn't launch an internal review to get to the bottom of this. No, they came out swinging with the confidence of a poker player holding a pair of twos who shoves his entire stack of chips into the middle of the table. They issued a denial so aggressive, so indignant, that it practically dripped with offended honor. They called the report malicious, false, and unsubstantiated. They claimed the methodology was flawed, the data was cherry-picked, and the accusations were a smear campaign by jealous short sellers trying to destroy a Chinese national champion. And here is the part that will make you scream at your screen. It worked. It actually worked. They pulled a Jedi mind trick on the entire financial ecosystem. These are not the frauds you are looking for. Citron Research, another famous short-selling firm, mind you, jumped in to defend Luckin, tweeting that the report was weak and that they were buying the stock. Think about the irony of that. A short seller defending a fraud against another short seller. The stock price didn't just stabilize, it rallied. It surged. For 2 months, Luckin Coffee held the door shut against the avalanche of truth. They looked investors in the eye, investors who were holding a detailed map of the crime scene, and told them, "Don't believe your lying eyes. Believe our beautiful growth projections." It was terrifying hubris. The executives knew the internal numbers were fake. They knew the cameras had caught them. They knew the receipts didn't match. But they gambled on the fact that greed is a powerful anesthetic. They bet that as long as the stock kept going up, nobody would care about the truth. And for a few agonizing weeks, they were right. You, the market, looked at the evidence of a crime, shrugged, and bought the dip. Gravity, unlike the SEC, eventually wins every single time. You can fight it with hype. You can suspend it with fraudulent accounting. But sooner or later, the laws of physics kick in. For Luckin Coffee, the ground rushed up to meet them on the morning of April 2nd, 2020. It wasn't a slow leak. It was a sudden, violent decompression. The company, cornered by its auditors who refused to sign off on the annual report without answers, finally blinked. They issued a filing that should have come with a trigger warning for anyone with a 401k. They admitted it. They didn't admit to a miscalculation or an accounting error. They admitted to a fabrication so massive it effectively erased the previous year of their existence. They confessed that the chief operating officer, Mr. Jian Liu, along with a handful of underlings, had fabricated approximately 2.2 billion yuan in sales. That's $310 million US. Poof. Gone. Admitted in a single press release. The revenue that had fueled the stock rally, the sales that had terrified Starbucks, the numbers that had seduced Wall Street. They never existed. It was monopoly money. The market reaction was visceral. It was the financial equivalent of a heart attack. When the market opened, Luckin Coffee stock didn't just fall, it plummeted off the face of the earth. In minutes, it crashed over 75%. Imagine watching your net worth evaporate 3/4 of its value before you've even finished your breakfast. Trading was halted. Circuit breakers tripped. The exchange tried to pause the slaughter, but you can't pause panic. Billions of dollars in market capitalization, wealth that belonged to pension funds, retail investors, and optimists, vanished into thin air. It was a bloodbath. And the excuse? Oh, the excuse was rich. The company tried to frame it as a rogue operation. They painted COO Jian Liu as a lone wolf, a bad apple who had somehow, inexplicably, decided to fake hundreds of millions of dollars in sales all by himself, without the CEO or the chairman noticing. It was an insult to intelligence. You don't fake that much volume without the people at the top knowing. You don't fake that much volume without the people at the top ordering it. But in that moment of collapse, the why didn't matter. Only the how much mattered. And the answer was everything. The tech unicorn was dead. All that was left was a donkey with a fake horn, lying in a pool of red ink. If this were a Hollywood movie, the credits would roll right after the crash. The villains would be in handcuffs, the heroes would be vindicated, and the company would be boarded up. A cautionary tale gathering dust. But this is global finance, and in global finance, the bad guys rarely go to jail, and the monster rarely stays dead. Welcome to the era of the corporate zombie. First came the humiliation. In June 2020, NASDAQ kicked Luckin Coffee out of the club. They were delisted. It was the ultimate walk of shame, stripped of their ticker symbol, banished to the over-the-counter markets, the financial equivalent of a dark alley where penny stocks and desperate gamblers hang out. Then came the fines. The SEC slapped them with a $180 million penalty. To you and me, that is an unimaginable fortune. To a corporation that faked hundreds of millions in sales, it was a parking ticket. It was the cost of doing business. They paid it, wiped the blood off their lip, and kept moving. And the executives, the architects of this disaster? Charles Liu, the chairman, and Jenny Chen, the CEO, were fired. But don't cry for them. In the corporate world, fired usually means you get to keep your personal fortune while the lawyers fight over the scraps. They didn't end up in a cell. They ended up in a boardroom struggle for control, fighting over the wreckage like pirates on a sinking ship. But here is the twist that will make your blood boil. The company didn't die. It pulled a move known as Chapter 15 bankruptcy protection. This is a legal shield that allowed them to restructure their debts in the U.S. while keeping their stores open in China. While American investors were using their Luckin stock certificates as toilet paper, the actual Luckin stores in Beijing and Shanghai kept brewing coffee. The app kept working. The blue signs stayed up. In a twist of irony so sharp it could cut glass, Luckin Coffee eventually did exactly what they lied about doing. They became profitable. After the fraud, after the crash, new management came in, closed the underperforming stores, raised prices, surprise, surprise, and actually built a real business on the ashes of the fake one. Today, Luckin has more stores in China than Starbucks. They are thriving. So, who actually lost? You did. The pension funds did. The retail investors who believed the hype and bought at $50 a share did. The capital that was incinerated belonged to the believers. The fraud effectively worked. It used your money to build a massive infrastructure at breakneck speed. And once the infrastructure was built, they flushed the investors, cleaned up the books, and kept the machine running. The parasite survived. The host died. It is the ultimate lesson in modern capitalism. If you steal $1,000, you go to jail. If you fake $300 million, you just restructure. So, what have we learned from this billion-dollar caffeine crash? If you think the lesson is don't trust Chinese coffee companies, you are missing the point entirely. That is too easy. That is lazy. The real lesson, the one that should keep you up at night staring at the ceiling, is that Wall Street does not want the truth. Wall Street wants a story. We talk about due diligence like it is some sacred ritual, a shield that protects us from the bad guys. But in reality, due diligence is a speed bump on the highway to riches. When a stock is doubling every few months, nobody, and I mean nobody, wants to be the guy in the meeting who raises his hand and asks, "Hey, does the math actually work?" That guy is a buzzkill. That guy misses the party. That guy gets fired for lacking vision. The market runs on FOMO, the fear of missing out. It is a biological imperative that overrides logic. When your neighbor is getting rich buying a stock you think is garbage, you don't feel superior. You feel like an idiot. and eventually, you buy. You buy right at the top, just before the trapdoor opens. Luckin Coffee wasn't a failure of regulation. It was a failure of skepticism. It proved that if you wrap a lie in enough technical jargon, burn enough cash to create the illusion of ubiquity, and promise the kind of growth that defies the laws of nature, smart people will line up to give you their money. They will defend you. They will attack the people telling the truth, because the lie is comfortable. The lie is profitable. The truth is just a cold, hard spreadsheet that tells you you're not as rich as you thought you were. And it will happen again. It is happening right now. Somewhere in a pitch deck being emailed to a venture capitalist this very second, there is a founder claiming to be the Uber of something absurd, projecting revenue that looks like a hockey stick, and hiding a business model that is structurally insolvent. And they will get funded. And they will go public. And you will probably buy the stock. Because we don't learn. We just wait for the next magician to walk on stage, hoping that this time the rabbit in the hat is real.